Hi guys! Welcome to Tax Q&A, your go-to resource for all things tax-related. Whether you're an individual looking to understand your tax obligations or a business owner trying to navigate the complexities of the tax world, we're here to help. In each video, we break down tax topics into easy-to-understand explanations, offering practical tips and expert insights. Subscribe and hit the notification bell so you never miss an episode. Let's dive into today's tax question. Capital gain tax. Guys, please feel free to pause the video to note down the important points in this video. Investing is a crucial part of building wealth. When you sell an investment at a profit, you'll need to pay taxes on those gains. This is called capital gains tax. Understanding how it works is essential for making smart financial decisions. Capital gains tax applies to assets like stocks, bonds, and real estate. It's triggered when you sell an asset for more than you paid for it. The profit you make is considered a capital gain. The IRS has specific rules and guidelines for calculating and paying this tax in 2025. We'll cover those in detail throughout this essay. By understanding these rules, you can potentially reduce your tax liability. Capital gains are categorized based on how long you hold the asset. Short-term capital gains apply to assets held for 1 year or less. Long-term capital gains apply to assets held for more than a year. The distinction is crucial because the holding period affects your tax rate. Short-term gains are taxed as ordinary income. This means they are subject to your regular income tax bracket, which can be as high as 37% in 2025. Long-term capital gains, on the other hand, benefit from lower tax rates. These rates are typically much lower than ordinary income tax rates, making long-term investing more tax efficient in 2025. The IRS adjusts capital gains tax rates periodically to reflect economic conditions and policy changes. These adjustments can have significant implications for taxpayers, especially those with substantial investment portfolios. For 2025, the long-term capital gains tax rates are as follows. These rates are crucial for investors to understand as they plan their financial strategies and make decisions about selling assets. 0%. This rate applies to taxable income up to $48,350 for single filers and $96,700 for married couples filing jointly. This means that if your income falls within these brackets, you won't owe any taxes on your long-term capital gains. 15%. This rate applies to taxable income above the 0% bracket and up to $533,400 for single filers and $600,050 for married couples filing jointly. This middle bracket captures a significant portion of taxpayers, making it essential to understand where you fall. For taxpayers filing as head of household, the long-term capital gains tax brackets for 2025 are as follows. 0% rate. Applies to taxable income up to $64,750. 15% rate. Applies to taxable income between $64,751 and $566,700. 20% rate. Applies to taxable income over $566,700. The head of household status typically applies to single or unmarried individuals who financially support a qualifying dependent and maintain a home for them. This filing status often provides a higher standard deduction and more favorable tax brackets compared to filing as single. 20%. This rate applies to taxable income exceeding the 15% bracket. High-income earners, particularly those with large investment portfolios, will find themselves in this category. It's important to note that these rates are for long-term capital gains only. Long-term gains are those on assets held for more than a year, which are taxed at these preferential rates to encourage long-term investment. Short-term gains, on the other hand, are taxed as ordinary income, as mentioned earlier. This means they are subject to the same tax rates as your regular earnings, which can be significantly higher than long-term rates. The 2025 rates are relatively similar to previous years, with some minor adjustments. These slight changes can still impact your tax planning, so staying informed is key to optimizing your financial outcomes. Calculating your capital gain might seem complicated, but it's fairly straightforward. By following a few simple steps, you can easily determine your capital gain, and ensure that you are accurately reporting it for tax purposes according to the 2025 IRS guidelines. It involves determining your basis in the asset and subtracting that from the selling price. The basis is essentially the amount you initially invested in the asset, which forms the starting point for your calculation. Your basis is typically the price you paid for the asset. This includes the purchase price and any associated costs that were necessary to acquire the asset. However, you can add certain expenses to your basis, such as brokerage fees or closing costs. These additional costs can increase your basis, which in turn can reduce your overall capital gain. These additions can reduce your overall capital gain. By including these expenses, you are effectively lowering the amount of profit that is subject to taxation. For example, let's say you bought 100 shares of a stock for $50 per share, totaling $5,000. This initial investment is your basis. You later sell those shares for $75 per share, receiving $7,500. This is the selling price of your asset. Your capital gain would be $2,500, $7,500, minus $5,000. This is the profit you made from the sale of the asset. Let's assume while buying these stocks you paid $100 as a brokerage fee. A brokerage fee is a charge or commission paid to a broker for facilitating financial transactions on your behalf. Brokers act as intermediaries between buyers and sellers in various markets, such as stocks, real estate, or insurance. The fees compensate brokers for their services, expertise, and access to trading platforms. When calculating your net profits from the sale of your asset, the broker's fee is minus from your total gain. In the above example, if your total net gain was $2,500, a sum of $100 will be minus from this amount, and your net gain would be $2,400. It's crucial to keep accurate records of your purchase and selling prices, as well as any expenses related to the asset. Proper documentation ensures that you can substantiate your calculations if needed. This documentation will help you accurately calculate your capital gains when you file your taxes. By maintaining detailed records, you can avoid potential issues with tax authorities and ensure that you are paying the correct amount of tax on your capital gains according to the 2025 IRS guidelines. Strategies for minimizing capital gains tax. In this section, we will explore various methods that can help you reduce the amount of capital gains tax you owe. By understanding and implementing these strategies, you can keep more of your hard-earned investment profits. Fortunately, there are several strategies you can use to potentially reduce your capital gains tax liability. These strategies range from simple timing techniques to more complex investment maneuvers. Each method has its own set of rules and benefits, so it's important to understand how they work. These strategies can help you keep more of your investment profits. By carefully planning your investments and being mindful of tax implications, you can significantly enhance your overall financial returns. Tax loss harvesting. This involves selling losing investments to offset capital gains. By doing so, you can use the losses to reduce the taxable amount of your gains, effectively lowering your tax bill. By strategically realizing losses, you can reduce your overall taxable income. This strategy is particularly useful in volatile markets where some investments may not perform as expected. If your losses exceed gains, you can deduct up to $3,000, $1,500 if married filing separately, against ordinary income. Unused losses can be carried forward indefinitely. Holding period. As discussed earlier, holding assets for more than a year qualifies you for the more favorable long-term capital gains rates. Long-term rates are generally lower than short-term rates, which can result in substantial tax savings. Retirement accounts. Consider investing within tax-advantaged retirement accounts like 401ks normally offered through the employers and IRAs. Individual retirement account. These accounts offer significant tax benefits that can help you grow your investments more efficiently. These accounts allow your investments to grow tax-deferred, meaning you won't pay taxes on your gains until retirement. This can result in a larger investment portfolio over time as your money compounds without the drag of annual taxes. Health Savings Account, HSA. Contributions grow tax-free if used for qualified medical expenses. 529 plans. No taxes on gains if funds are used for qualified education expenses. Contribute appreciated assets to charity. Benefit: avoid paying capital gains. Tax on donated assets while receiving a charitable deduction for the full market value of the assets. Strategy: donate stocks, mutual funds, or other appreciated investments directly to a qualified charity. Gifting appreciated assets. Benefit: shift tax liability to someone in a lower tax bracket, for example, a child or other family member. Use the annual gift tax exclusion, $19,000 per recipient in 2025, to transfer appreciated assets without incurring gift taxes. In 2025, the IRS has set the annual gift tax exclusion at $19,000 per recipient. This means you can give up to $19,000 to any number of individuals without incurring gift tax or needing to file a gift tax return. For married couples, this exclusion effectively doubles, allowing combined gifts of up to $38,000 per recipient without tax implications. Be aware of the kiddie tax rules for minors. Make use of 1031 exchanges. Real estate. Defer capital. Gains taxes on the sale of investment or business property by reinvesting the proceeds in like-kind property. The applicable criterion is that the exchange must be finalized within 180 days. This, however, applies only to real estate used for investment or business purposes, not personal property, such as stocks or bonds. By implementing these strategies, you can potentially minimize your tax burden and maximize your investment returns over time. It's always a good idea to consult with a financial advisor to tailor these strategies to your specific situation and goals. Remember, the strategies for saving money on capital gains taxes are all fully aligned with IRS laws and guidelines, ensuring that you can optimize your tax savings while staying compliant and avoiding any legal complications. The IRS provides a valuable exemption for homeowners when they sell their primary residence, as of 2025. This is known as the home sale exclusion. It allows you to exclude a significant portion of your capital gains from taxation. Single filers can exclude up to $250,000 of capital gains, while married couples filing jointly can exclude up to $500,000. This exclusion can be a substantial benefit for homeowners. To qualify for the exclusion, you must have owned and lived in the home as your primary residence for at least 2 of the 5 years before the sale. This exclusion can significantly reduce your tax liability when selling your home. Failing to report and pay capital gains taxes can have serious consequences. The IRS takes tax compliance very seriously. Penalties for non-compliance can include fines, interest charges, and even legal action. The penalties can quickly escalate the longer you delay addressing the issue. It's essential to understand your tax obligations and ensure you are in compliance with IRS regulations for 2025. If you realize you've made a mistake or omitted information on your tax return, it's crucial to contact the IRS immediately. They offer various options for resolving tax issues, such as payment plans and penalty abatement, under the 2025 guidelines. Capital gains tax laws can be complex and nuanced. If you have significant capital gains or are unsure about your tax obligations, it's always advisable to seek professional guidance from a qualified tax advisor. A tax professional can help you understand the specific rules that apply to your situation, optimize your tax strategies, and ensure you are in compliance with all IRS regulations for 2025. While seeking professional advice does come with a cost, the potential tax savings and peace of mind it provides can be invaluable. A tax professional can help you navigate the complexities of capital gains tax and make informed decisions. Understanding capital gains tax is crucial for making informed investment decisions and achieving your financial goals. By grasping the concepts of short-term and long-term gains, knowing the current tax rates for 2025, and utilizing strategies to reduce your tax liability, you can optimize your investment outcomes. Remember to keep accurate records of your investments, seek professional advice when needed, and stay informed about any changes in tax laws for 2025. With a solid understanding of capital gains tax, you can invest with confidence and build a secure financial future. Investing is a journey, and understanding the tax implications is an important step along the way. By being proactive and informed, you can make the most of your investments and achieve your financial aspirations. It's important to remember that your tax professional is more than just someone who files your taxes. They're a valuable partner in your financial journey. Make it a habit to ask questions about your tax obligations, potential deductions, and future planning strategies. Whether you're unsure about a recent change in tax laws or want to explore ways to save on your taxes, open communication is key. Don't hesitate to reach out and discuss your concerns or goals. A proactive approach not only helps you stay compliant with IRS guidelines, but also allows you to make informed decisions that can positively impact your financial future. Your tax professional is there to guide you. Make the most of that relationship. If you found this video helpful, share it with others who might benefit. And as always, consult a tax professional for personalized advice. Thanks for watching, and please share your views with us. If you have a tax question you would like that to be answered, please post your question in the comments section below. Stay informed, stay prepared, and let's make taxes less taxing together. See you in the next video.